Hi, everybody. It's Leslie with New Mexico Small Business Development Center. I want to welcome everyone to today's webinar. We have Ian Alden. He is a practicing attorney here in New Mexico, and he's going to give us information and speaking to us today on moving your business to New Mexico and everything that's involved with that. If you have any questions, please type it into the Q&A and we'll pick them up just as quickly as possible. So with that, I'm going to turn it over to Ian Alden. Welcome.
Thank you very much, and good afternoon, everyone. I'm happy to be here for today's workshop. Before I get started in the workshop, I do want to point out a few of the ongoing COVID-19 resources available to business owners here in New Mexico. There's a number of resources available, a lot of which focus on how to maintain COVID-safe workplaces. It's especially important now that businesses are opening up again. Obviously more and more people are getting vaccinated and our, a case rate is down, but it's still important to maintain COVID-safe workplaces and best practices. So be sure to check out some of these resources to learn what you can do to do that. Now, before we get started, you should all have your microphones muted by default. If for any reason yours is not, please make sure it's muted. Be sure to set your Zoom ratio to fit window. That's so you can see all of the slides. You don't want to have some of the slides cut off, so be sure your Zoom ratio is set to fit window if it isn't already. We will be using the Q&A function here in Zoom to take your questions. If possible, try to give your questions there instead of in the chat. I'll be taking questions on an ongoing basis as the presentation continues, and then I've got a bit of time at the end for more questions. So be sure to submit your questions that way, and I will get to as many as I can. And when you're preparing your questions, if you can write down the slide number that your question relates to, that would help so we can go back and reference it. You can see the slide number in the bottom right-hand corner of each slide. So before we get started, just a reminder of some of the other upcoming workshops and training seminars that SBDC is offering. We've got plenty this week, a number of interesting ones. I'm actually very curious about the spying on the competition one. There's plenty of resources available through the SBDC and some great training workshops, so be sure to tune into those as well. Now, I've broken down this presentation into 4 parts. We're going to talk about the different ways one can move a business from one state to another, some of the essential considerations that go into deciding which one you pick, some logistical hurdles that go into moving your business, maybe things that you haven't really considered before, but that seem to come up time and time again with my own clients. And then some hidden opportunities for people who are maybe considering moving to New Mexico, but maybe on the fence about it. Now, I assume that most of the people attending this presentation are already New Mexico business owners, but there's a lot in this presentation, even for you, just in terms of, different business structures or things to consider. Maybe you are one of those people who is looking at moving to New Mexico. Maybe you know someone who's going to move to New Mexico, or maybe you've got businesses in other states that you want to move to New Mexico. In any event, I do hope you get some good information from this presentation, and be sure to check out some of the other SBDC presentations and workshops that deal with what to do once your business is already here. There's lots of gems out there. Now, when you move as a person, it's usually pretty simple as a concept. I mean, you sell or leave your home in one state, find another home in your new state, and then you just pack up and move there. Once you're there, you're essentially a resident. Every state has its own residency requirements. Maybe it takes 6 months. Maybe you need to go get a driver's license. But in any event, it's a physical act of uprooting. Businesses, it's not quite so simple. There isn't a physical uprooting because businesses, especially business entities, they only exist in a particular state in which they're formed. They exist as a product of a particular state's laws. So when you make a corporation or when you make a limited liability company, or even when you make a partnership or a trust, your entity exists as a product of that state's laws. It's not, I have a limited liability company. It's, I have a New Mexico limited liability company, or I have a Delaware corporation. The state matters because no two states are identical, and forming a business in one state doesn't mean it exists in all the others. Um, Remember that business entities are distinct legal entities that are separate from their owners, with the exception being a sole proprietorship. A sole proprietor really is just a person doing business as maybe a trade name, but sole proprietorships are the same as their owners for legal purposes. So if you move and you're a sole proprietor, your sole proprietorship moves with you automatically. But for the rest of this presentation, we're talking about the formal business entities, corporations, LLCs, and to an extent, partnerships and trusts, but really the first two. Now, as I mentioned, LLCs and corporations in particular only exist by virtue of the LLC Act or the Corporations Act in the states in which they're registered. So you form an LLC in New Mexico, for example, and it's formed under the New Mexico Limited Liability Company Act. Texas has something similar, Wyoming, Nebraska, California, Arizona, Colorado, you name it. Every state has its own form of the LLC Act, and every state has its own form of the Corporations Act. But by and large, no two states are identical. And so it's important to understand that your company is formed under the laws of a particular state. Now, you can register your company, your LLC, your corporation secondarily in other states in a process that's called foreign qualification. So, let's say I've got my LLC in New Mexico and I want to start doing business in Texas as well. I want to hire Texas employees. I want to open up a branch location in Texas. Maybe I've got a coffee shop and I'm doing well and I want to expand my reach. Or maybe I want to open up a factory or buy a warehouse in Texas. Whatever the reason may be, I can register my New Mexico LLC secondarily in Texas. And all of a sudden, my LLC is registered in both states at the same time. Same with corporations. When you're talking about registering as a foreign entity, you're taking one company and having it formed in multiple places. It's still a domestic entity of its home state, which means, it's still a New Mexico limited liability company, even if it's registered secondarily in Texas. It still has a home state and it's foreign registration states, but it lets you do business across the board, which is pretty handy. You can do business in any state you're registered in. So you can be registered in one state, two states, 5 states, 50 states. You can register your company across the board if you want to spend that much time and money on it. I don't recommend it for most people, but it's doable. The nice thing is it really is one company, multiple places. So you only have one federal EIN, employer identification number. You only have one bank account, despite being in multiple states. You'll probably need a different state tax ID number for each state you're registered in. That's just the consequence of registering in that state. If you're doing business in a state, you're probably going to have to report and pay some sort of taxes in the state. There's corporate income tax for C corporations and some S corps. There's franchise taxes, sales tax, gross receipts tax, which is a big one here in New Mexico. So, when you're registered in other states, you're subject to the laws of those states and you need to register and pay what's due. We're getting into the options for different ways to move from one state to another. And so we're talking about registering as a foreign entity first, as option number one. The big drawback, apart from being exposed to multiple states' laws and having to possibly file and report and pay taxes in multiple states, the big drawback is you're not technically moving anything. Let's say you are a California business owner and you want to move to New Mexico. You do the foreign registration in New Mexico. You've got your California LLC and you register it here in New Mexico secondarily. Great. Now your LLC is in two places, but its home state is still technically California. So you're still paying California's $800 a year franchise tax on your LLC, even though you've moved to New Mexico. And even though your LLC is registered in New Mexico, you don't get out of the home state just with registering as a foreign entity. So, that's the big drawback here in terms of approaches to moving from one state to another. But, if you're going to maintain a footprint in your previous state, let's say you're moving to New Mexico, but you want your company to keep doing business in the old state and the new state, maybe this is the solution for you because your company is in two places and logistically, it's very simple to accomplish. You just register your company as a foreign entity, you get maybe a certificate of good standing from the state your company was originally formed in. It all takes maybe a week or two. It's pretty cheap, quick and easy. So that's registering as a foreign entity. But let's say you really want to move your company. You're moving from your home state to the new state. Let's say you're moving again. I use California a lot as an example. I deal with a lot of clients who are moving from California. So I'm just going to keep using that one. Let's say you move from California to New Mexico and you want to take your company with you and you don't want to be subject to California's laws or taxes, franchise tax. You don't want to have to keep reporting to California, you name it. You want to move your company. Well, here's a theoretical option. And I say theoretical because you can see in parentheses, not available in New Mexico. But it's important to understand this option and what it is. A, because maybe New Mexico's legislature will finally get with the times and start allowing it like other states. And, it's just important to understand what the different options are because maybe you're doing research online and you see this great thing called domestication and you say, well, why don't I just do that? The answer is right now it's not available here. But domestication, think of it as the second step to foreign qualification. You register your California LLC in another state as a foreign entity. You move to that other state and then you say, okay, I'm bailing on California. I want to move my company. I just don't want to have it registered in two places. Domestication is a process by which you take your foreign registration in a new state. Let's use Texas as an example because it actually allows this. But you're foreign registered in Texas. You say to the states of Texas and California, I now want my Texas registration, my foreign registration here in Texas to be my domestic registration. Texas is now the new home state of this LLC. That's what domestication is. It is changing the home state of your LLC. So all of a sudden, the home state of your LLC is no longer California, it's Texas. Then typically you cancel the California registration altogether and you're left with your Texas company. That's domestication in a nutshell. You set up shop in one state, register in a second state as a foreign entity, and then you make that second state the home state of the company, and then you cancel it out in the first state. It's logistically pretty simple. It's cheap. Well, relatively cheap. It's not as cheap as just foreign registration, but it's cheaper than some of the other options we're going to talk about in a minute here. You preserve the old identity in its entirety. So you preserve the EIN, the credit profile. Usually you preserve the length of existence of the company. So, you look at the company in the Secretary of State database and you see formed in 1998, for example. You've got a company that's been around for 23 years. Oftentimes you want to keep that date because it shows that your LLC, your company has longevity to it. It's got some health to it. In domestication, in many states, you can keep that formation date once you domesticate the company. Not all states. Some states will make you use the date of your foreign registration, which not ideal, but some states will let you keep the length of the company in there. You don't have to do any transfer of assets with this approach because, it's the same company. Company A that was formed in one state, then was formed in two states, then was just formed in one state again. It's the same company, so nothing needs to move over. And since nothing moves over, nothing changes hands or changes ownership, it's typically not a tax recognition event. And that's important to understand because a tax recognition event, it's an event where, something happens, you sell a company, for example, you have to recognize the gains or losses for tax purposes when that event happens. That's what we mean by recognition, is that you have to recognize and then ultimately report and pay any taxes you might owe in that event. So domestication, it's a great option when available because it's relatively quick, relatively cheap. It's simple, it preserves the company, and there's no tax recognition event. So you don't have to worry about the IRS coming after you and saying, "Hey, the assets from this company changed hands when moving from state one to state two. We're going to assess you taxes on it." Now, I've got a little asterisk here because state tax treatment of these sorts of processes varies wildly by state. And I mean wildly. And I'm going to talk about this a little bit later in the presentation, but it's important when you're moving from one state to another that you do your research in advance, know what the tax consequences are going to be of the move, and plan accordingly, because you don't want to find yourself after a move suddenly faced with a huge tax bill because you didn't know there's going to be a tax recognition event on the federal or state level. So talk to a good accountant or CPA, talk to a good tax attorney. Really plan this out ahead of time. It'll save you a lot of headache and grief after the fact. Some of the cons of domestication, because there are some cons to it. It's a nice and handy approach, but a lot of people, when they move their company, they want to take the opportunity while they're moving to restructure it. As an example, a lot of people who formed corporations back in the 80s or 90s are looking at LLCs now and seeing how nice and flexible they are and convenient they are. And they say, well, I'd like to have an LLC so I don't have to deal with all this corporate reporting and annual state reports and annual meetings and minutes and keeping up with all the niceties of corporations. Maybe they have a different reason why they want an LLC. They want to convert to a partnership for tax purposes. Who knows? Domestication doesn't let you do it. Domestication, you are literally preserving the entity in its previous form, just in a new state. And so there's not much ability to restructure when you domesticate. And the big con of domestication, some states, including New Mexico, don't support domestication because pretty much all the domestication laws require that both the origin state and the destination state, the state where the company was originally formed in and the state where it's moving, they must both support domestication in their state laws for it to be used as an option. It's not a controversial thing to allow domestication. There's some protectionist arguments against doing it. You don't want to let your companies move out of state. But the bottom line is it's by and large an accepted practice where it's allowed. Our state legislature just hasn't taken up the issue or considered it in the last 10, 15 years since domestication really took off. So we're hoping one of these days they do, because that'll make it a lot easier for businesses to move into New Mexico as well as out of. But for now, just know that it's not an option in all states, and you need it to be an option in both the origin and destination state. Now, the third method I want to talk about is what's called a statutory merger. And I say statutory merger because for it to work, there needs to be merger statutes on the books of the states in which you're trying to move out of and move into. Now, statutory mergers are fairly old as a concept. I'm not aware of any states that don't allow them or have laws on the books, but the reason it's called statutory merger is because it's merger under the laws of the states you're moving from and moving to. It's not as handy as domestication because domestication, it's a much simpler and cheaper process. One LLC goes from one state to two states back to one state, just from the origin state to the destination state. Domestication, it's very simple and easy. Statutory merger, it's a different process entirely. Let's say you're in California and you want to move to New Mexico. You've got your LLC in California. You would form an entirely new LLC in New Mexico. You'd typically want it to be the same name if you want to preserve the EIN, which we'll talk about later, because an EIN is issued to a company with a specific name You can change the name that the EIN is registered to, but it's a bit of a hassle, and I usually don't recommend going that way if you can help it. But in any event, you make an entirely new LLC in your destination state. Brand new, not necessarily related to the old LLC in any way, except that it would be owned by the same people. You'd have common ownership between the LLC in California and the LLC in New Mexico. What you then do is merge, and use air quotes because it's a nebulous concept. You merge the old company into the new company. Think of it as sort of, in the traditional corporate context, company, company one buys company two merges into company one and ceases to exist. Company two continues to exist, and all of a sudden it owns company one as well. That's what a merger really is, except you're folding basically all of the assets of your first LLC into the second, resulting in the survival only of the second LLC. The first LLC is canceled as soon as the merger happens. So it's a lot like domestication, but a little bit different in some ways. We'll talk about here. Um, the original entity is legally deemed to be continued in the surviving entity, which means the business continues uninterrupted. The EIN and the credit profile or DUNS score can transfer over. You don't need to move assets or get new bank accounts, though you may want to get a new bank account in your new state anyway, especially if your old bank doesn't really have a branch there, which we'll talk about in a little bit. But it's like a domestication in the sense that there's no tax recognition event on the federal level, though, again, varies by state. The big difference is the new LLC is more formally recognized in the merger. So there's no way to preserve the longevity of the company. For example, what you're left with is a brand new LLC in the state you're moving to with a formation date equal to when you created that second LLC. You can't preserve the old LLC start date. It's a little more, and by a little more I mean it's much more complicated to do a statutory merger because you really have to do some research into the statutes and follow what tends to be a pretty lengthy and arduous process. So in terms of cost, and I'll just say this for my own clients as an example, the cost to do a statutory merger is multiples higher than a domestication, 4 or 5 times more expensive just in terms of the paperwork and process and procedure that needs to happen. So they're just a barrier really as compared to domestication, but it's a great option if you need a continuity of business, if you need to preserve the EIN, which a lot of companies do. They need their EIN, they need their DUNS number, they need their credit profile intact. So statutory merger is a great option if domestication isn't an option. It's very rare that I'm going to recommend people do a statutory merger in lieu of domestication, but it happens from time to time. That's an option to consider. Option number 4, and this is a really interesting one. This is where we really get into customization. It's called an asset purchase. And you deal with asset purchases a lot when you're buying a business. I gave a workshop on this a few weeks ago, buying and selling businesses. There are 2 primary forms of that. There's the stock purchase and the asset purchase. If you think of the company as a giant wrapper or a container that's full of assets, physical, tangible assets like equipment, inventory, furniture, vehicles, etc., and then intangible assets like the name, the trademark, copyrights, intellectual property, goodwill, etc. Think of an LLC or a corporation as just a giant container that holds all of those assets. In a stock purchase, you buy the container. In an asset purchase, you buy all the assets out of the container and put those assets into a brand new container that you make. An asset purchase can be used to move your company from one state to another. Thinking of the LLCs as containers, you open up a new LLC in your destination state like New Mexico. And then you go through an asset purchase where your new LLC buys, again, note the air quotes, buys the assets from your old LLC in a process by which, either you're buying them for no value, which can be tricky, and I'll talk about that a little bit. Or you're buying them for actual fair market value. Let's say you put a bunch of money into the new company, and then the new company buys the assets from the old company for fair market value, and then you as the owner of the old company just take that money right back out. That happens a lot with these asset purchases. It prevents some tax issues down the road having to do with tax basis in the assets and depreciation, which, we'll cover in a little bit here. But the gist of it is, new company buys the assets of old company, and then old company closes up shop thereafter. It's nice for a few reasons. The first reason is that you're buying the assets, but not necessarily the unforeseen liabilities. So let's say, company one was operating a business. It had customers over the years. You never know when a customer is going to come out of the woodwork and sue the company. If company one goes through an asset purchase and then closes up shop, and then company two buys the assets and continues the business, you might be able to get out of some of those liabilities. The unforeseen liabilities of maybe a lawsuit from a customer of the old company. I say might because there's still things like piercing the corporate veil or successor in business liability that they can argue in front of a court. It's never a surefire thing, but it at least gives you a possibility of doing that. Really, the bigger pros of an asset purchase is that, one is the cheapest way to move a company, or one of the cheapest. I still think domestication is cheapest when you factor in time, because domestication, it doesn't take that much time to do, and it doesn't take that much effort. It might be a little more expensive as a matter of filing fees, but it's a bit easier. But asset purchase is still a very cheap and easy way of doing this, and it's also the easiest way to convert your company from one type to another during the move. For example, the example I gave before, someone has a corporation and all of a sudden they want to convert it to an LLC as part of their move. You can do that with this option number 4, with the asset purchase. You form an LLC in the new state, and then the LLC buys the assets from your corporation in the old state. Now, those are some of the pros to the asset purchase, but there are a number of cons that you need to be aware of. Now, the first con, and this is a big one for a lot of my clients, the original entity is not preserved at all. And I mean at all. Like, you're starting over with a brand new company, new EIN, new bank accounts, new credit profile, the works. I mean, you can start with a new name if you want to. There's nothing that binds you to that name at that point because you're getting a whole new EIN anyway. It is a distinct legal entity, distinct from the previous company. Clean slate. But I get a lot of questions. Well, can I use the old EIN anyway? And the answer is you can, but the IRS pretty clearly suggests that you need to get a new one. And so there can be some odd consequences or implications if you try to recycle the old one. You need a new EIN, new bank accounts, starting over. The other huge con is that this process can often result in a tax recognition event for the business owner. And I'll give you an example of this. Let me see if I have it on the next slide. I don't have it on the next slide, so I'll just outline it for you. You own a C corporation in California. The C corporation owns its assets outright. You're starting an LLC in New Mexico that's going to be a disregarded entity, or taxed as a sole proprietorship for tax purposes, even though it's an LLC. The LLC buys the assets from the California corporation in an asset purchase. That is a tax recognition event where the California company is going to have to report the gains or losses from the sale. There's certain rules that come into play if the sale is not done in what's called an arm's length transaction for fair market value. You might be disallowed the losses on the sale of the assets if you don't sell them for fair market value, for example. But the California company might then have to pay, let's say it has some gain on those assets. It's going to have to pay 21% federal corporate income tax rate potentially on the gains. Might have to pay California state corporate income tax on the gains. And then it's treated automatically as a distribution of those assets in liquidation from the company to its shareholders. So, you know, corporate income tax may not apply in that situation, but in that situation, you might be dealing with personal income tax on the distributions of the assets, depending on their fair market value. The tax recognition situation can get a little wonky depending on the unique situation of, the home company, the company A and company B, and the owners, and how everything is taxed. And so I don't want to get bogged down in the weeds of what it would actually look like, because the situations really can vary dramatically. But just know that asset purchases can result in tax recognition events, even if it's the same owner of company A and company B, and you're just trying to accomplish a move. So you really need to thread the needle here and plan accordingly. Again, I always recommend people have a good tax accountant or CPA or tax attorney on hand who can plan the transaction in advance, so you know what the options are and you can avoid any nasty consequences if possible. The other big thing, and this is what I was talking about earlier, um, doing an asset purchase incorrectly can result in personal liability or successor and business liability for the business owner, especially if company A has debts or obligations that the owner knows about. Because, it's one thing if there's an unforeseen potential customer who might come out and make a claim years down the road. It's another thing entirely if you're trying to move from state A to state B, and you do this via an asset purchase, and your company in state A has a bunch of credit card debt or business debt, loans, promissory notes, you name it. Doing an asset purchase could well result in a default of those debt obligations. And if you do the asset purchase in such a way as, you're not transferring the assets for fair market value, company A isn't getting money that it could use to satisfy its debts. That's a prime example of a way in which courts will allow the creditor to go after the owner of the company personally for the debt of the company, in what's called piercing the corporate veil. So if you're doing an asset purchase, you really need to, again, plan the transaction in advance. If you have debts that you know about, you either need to settle them in the case of an asset purchase, or make sure that you negotiate with the creditor such that the new company assumes the debt and carries the debt forward. Because failure to do either of those things could well result in a default, and that's not a situation where the debt is simply going to die with the business. That debt will probably be assumed by the owners of the company, which you typically want to avoid. So, prior planning. Now, before I jump into this next section, I'm going to check to see if there's any questions in the Q&A. I don't see any. So let's talk about some essential considerations here. Now, the first big consideration that I want to cover, it's probably the most glaringly obvious. What options are actually available to you? Because it varies by state. We already know the options in New Mexico: foreign qualification, statutory merger, and asset purchases. Domestication is great if it's available, but if it's not available, there's no sense in fretting over it. You just have to pick from the other three. So that's a big consideration there. Seeing a lot of chat activity. Just want to make sure there's no questions in there. Nope. Okay, so the next consideration, are you happy with your existing structure? I get this a lot from owners of corporations where they say, I'm not happy with my existing structure. I am tired of having to deal with the annual or biennial reports to the state that corporations have to do that a lot of LLCs don't. I'm tired of having to deal with annual meetings and keeping minutes and keeping track of all that. I'm tired of having to deal with stock ledgers and sort of the formalities of a corporation. Or maybe I have a company that's taxed as a C Corp or an S Corp, and I just want to change to simpler tax treatment. I want to have it taxed as a disregarded entity going forward. I still want the protections of maybe an LLC, but I don't have to deal with all the complicated tax filings. I'm not getting anything out of it. If you're not happy with your existing structure, you're looking at an asset purchase or maybe a statutory merger, Some states will allow you to convert entity types in your statutory merger. Most states won't, but you never know until you look. But that's a driving force behind what approach you pick to moving your company. This is a really fun one. Consideration number 3, what's different about the destination state? What's different about the state I'm moving to that might force my hand to pick one approach or another? Because, and here's a fun fact that, you know, we are reckoning with every time we deal with a move. Some states, as an example, don't recognize S corporations, subchapter S corporations or S corps for tax purposes at the state level. Because an S corporation, it's like a C corp, it's a corporation, but it's also a pass-through entity. The profits and losses pass through from the S corp or an LLC taxed as one to the owners of the company, and the owners pay the taxes at their personal, federal, and state rates. So corporate income tax, that second layer of taxation, the corporate income tax at the federal and state level, typically doesn't apply to S corps, only to C corps. So, pass-through entities, at least at the federal level, but some states don't recognize S corps as pass-through entities, or maybe they do, but they still charge what's called a franchise tax. It varies dramatically by state. Some states like Texas will charge a franchise tax on S corps. New Mexico charges one, but it's pretty nominal. I think it's like $50 for most of them. Some states charge franchise taxes that vary based on the value of property within the state or the amount of revenue that the company is bringing in. It varies by state. Some states will try and charge the actual corporate income tax rate to an S corp formed within their borders. Tennessee has a very strange approach. So a lot of clients who want to move to a state like this, maybe they have an S corp in one state and they're moving to a state like Tennessee, stop them and say, hey, think about this for a second. Do you want to continue to be an S corp in a state that's going to treat you like a C corp? The tax consequences are going to be bad. They say, no, maybe I want to restructure as an LLC taxed as a disregarded entity so that I am paying as little in taxes as possible, and I'm reducing my tax paperwork because now I don't have to do quarterly tax returns. I don't have to do payroll taxes. I don't have to deal with unemployment or workers' comp for myself. When you have an S corp and you're the only employee as the owner, maybe you want to simplify your life, and this is the great impetus to do it. So this can derive the choice of what process you use when moving your company. This is turning out to be huge nowadays. And so I, again, repeat my suggestion: do your research or hire a lawyer to do it for you, but figure out what's different about your destination state so that you know what you're moving into. So again, big consideration, what about taxes? How will my move be treated for tax purposes? In an asset purchase, again, it's often a tax recognition event. So if it's a tax recognition event, you need to look at the situation more thoroughly, look at what the potential taxes might be, and figure out, it's a tax recognition event, but does that mean I actually owe any taxes here if I do an asset purchase? If the answer is no, then great, go forth and conquer. If the answer is yes, and because of maybe some depreciation that you took in those assets, maybe because of the way you want to do this, where you're not going to pay fair market value, etc., maybe you don't do an asset purchase. In that case, maybe you do a statutory merger or domestication if you can. And I'm going to lump into this, even though it's not in the slide, what about my other obligations or debts? Like if the company has debts, maybe an asset purchase isn't the right approach for you because you don't want to renegotiate those debt instruments with the creditors. Maybe you don't want to go through that process and you just say, okay, I'm going to do a domestication or a statutory merger so that the company is preserved, the debts remain uninterrupted, I just assume them and move on with my life. That might just be the simplest and easiest approach for you. I might sound like a broken record on this, but talk to a competent professional, talk to your accountant, your CPA, your tax attorney before you move the company. It's going to save you a lot of time, a lot of headache, a lot of potential liabilities that you just don't think about when you do the move. Consideration number 5, and this isn't really a consideration about which choice of process you use. It's more a consideration across the board, but it's something that people often forget about, and so I have to remind them. Registered agents. Your registered agent, they are a point of contact who can legally accept service of process on behalf of your company. So the registered agent, they are they have to reside within the state lines of the state in which your company exists. So, as an example, if you have a company that you form in New Mexico, you have a registered agent within New Mexico that can accept service process on behalf of the company. They're publicly listed in the Secretary of State database. Anyone can look them up, see who they are, and serve a lawsuit on them. That's literally why they exist. Um, let's say you form that company, you register it secondarily in Texas or Colorado. All of a sudden, you need registered agents in those states as well. Every registered agent for the state has to be within the state in which the company is registered. So you need multiple registered agents at that point. Similarly, if you're moving your company from state A to state B, you need a registered agent in state A and then in state B, possibly in both states at the same time, depending on the type of move you're doing. So, it's important to do your research and make sure that you've got the registered agents you need as you do the move. So that way you're not left holding the bag. Your LLC doesn't lapse for non-compliance, for example. Same with corporations. I mean, every type of business entity that's registered needs a registered agent. When our firm does this, and I know this is true across the board with a lot of other firms and companies, we have corporate registered agent services. We have contracts and affiliates in all 50 states. Most other services that do relocations do as well. You can also just find those registered agent services and hire one yourself if you need a registered agent and don't already have one that you can designate. So there's ways to do this, but it's an important thing to keep in mind and not forget about when you're moving your company. Now we've got a question in the Q&A. Should you be your own registered agent? That is a great question. The answer is it really depends. If you have what's called an anonymous LLC, which I talked about a bit in a workshop a month or two ago on business structures, if your company is anonymous, and by anonymous, that means that your name and identifying information is not publicly listed in the Secretary of State database, then the answer is absolutely not. You don't want to be your registered agent because that is listed in the Secretary of State database. But if you don't have an anonymous LLC, anonymity isn't a concern, you don't mind having your name publicly tied to the company, you don't mind being listed as the registered agent such that someone can serve a lawsuit on you for the company, then sure. But keep in mind a few things. You have to physically reside in the state in which you're going to be the registered agent. So if you have a company that's registered in New Mexico and Texas, for example, and you reside in New Mexico, you can be the registered agent for the New Mexico registration, but not for the Texas registration. So you need a second registered agent in Texas. Similarly, if you're moving your company through a process of domestication, where you register, you live in California, for example, your company's registered in California, you register the company in New Mexico as a foreign entity, and then you do the move where all of a sudden New Mexico becomes the primary home of the company and the California registration terminates. For some period in time, your LLC is registered in 2 states. You only reside in one ever. So you would need a second registered agent for whichever state. If you personally move before the company, you need a registered agent for the California company. If you move after the company, you need a registered agent in New Mexico. Point being, these are situations where you would need 2 registered agents. You can only ever be one. So you need to figure that out, again, either with a corporate service or maybe you have an employee or someone who already lives in that other state. You can designate them as the registered agent for that state. So we've got another question. Oh, that one was answered. Okay. Um, so some logistical hurdles that people run into. I get this all the time. What else do I have to do? Keep in mind, I'm an attorney. I do some business consulting, but I'm not by trade a business consultant, and I'm not really a business mentor or advisor. So I can't really tell you everything you need to do from a business standpoint, but I can tell you these are a lot of frequently asked questions that I get, and some common hurdles that I advise people on. Um, it's important before you move your company and when you're planning it to really look at some of these and plan ahead. Um, I was in ROTC when I was younger, and this acronym really stuck with me. Prior planning prevents poor performance. It holds true when you're moving your LLC or corporation or business, especially. So keep it in mind. Plan ahead for these things. The first is state level tax IDs. Every state you're doing business in is going to require that you register with your state tax board, franchise tax board, whatever the taxing authority is. New Mexico, it's our taxation revenue department. So when you're moving into New Mexico, you need to make sure that you're getting what's called a combined reporting system, or CRS ID. That's what's going to let you report and pay gross receipts tax, corporate income tax. You'll need to register for corporate income tax if you've got a C corp or an LLC tax as one. Franchise tax. I mean, CRS specifically deals with gross receipts and compensating taxes, but you'll also need to register for, like I said, corporate income or franchise taxes if you need to pay those as well. Um, Again, we talked about this earlier with foreign qualification, but companies registered in multiple states simultaneously may need to report and pay taxes to those states, to multiple states at a time. It's a headache, it's a pain, but it's something you'd have to do. So plan ahead for that, especially if you're going the foreign qualification route. Payroll, unemployment, and workers' comp. This is a big one if you're moving into New Mexico or to any other state which has a lot of these schemes. I mean, every state has their own form of unemployment because it's a federal sponsored program that's administered at the state level, often with state funds thrown into the mix. So you'll need to figure out what the unemployment and workers' comp rules and requirements are for the state you're moving into. For New Mexico specifically, we've got workers' comp requirements where you need to go get a workers' comp policy if you have X number of employees, which in certain cases can include the owners, depending, for purposes of the calculation. But you may need to go get a workers' comp policy. So you might want to find an insurance broker to help with that. Similarly, we have an unemployment insurance scheme that's managed by the state that you need to pay into based on number of employees you have, risk factors. They look at, over time, how many terminated employees you have who claim unemployment. The rates fluctuate, but you need to deal with the Department of Workforce Solutions and make sure that you're complying with the unemployment requirements. You also need to make sure that you are withholding appropriately from your employees' paychecks and remitting to the state, as well as to the federal government. I mean, you do this on a federal level quarterly, if not monthly, with payroll withholdings. So you have to do the same for the state. I usually recommend that you find a good payroll provider, either a national one or a regional or local payroll provider, just someone who is familiar with and can deal with New Mexico as well as the federal government, because you're not well served. For example, if you're moving from California to New Mexico, I see this a lot with people where they try and keep their original payroll providers, CPAs, accountants, and then years down the road, it comes back to bite them because their accountant or provider didn't properly remit to New Mexico the taxes they're owed. Or I see this a ton, their previous accountant had no idea about a gross receipts tax system or how it worked, and they just didn't tell the business, and the business never withheld or paid gross receipts tax, and then they found themselves faced with hundreds of thousands of dollars of tax debt a few years down the road. So it's really, really important. And I'm not trying to be parochial here by saying, shop local, buy New Mexico. It's just a reality that you want someone who's familiar with the processes, the laws, the requirements of the state you're moving to help you through this. So find a good payroll provider, a good accountant, tax attorney, etc., familiar with the state you're moving to. Bank accounts. Like I said, with an asset purchase, you need new bank accounts because it's a brand new entity. There's no continuity. Other approaches will let you keep the bank accounts if you keep the EIN. You can't keep the bank account without keeping the EIN because they're intrinsically linked. But if you can keep the bank account, you can. Maybe you don't want to. Maybe practically speaking, you need a new one anyway. And here's an example for me personally. When I moved here from Boston, um, certain banks that are prevalent in Boston, Chase, Capital One, even Citizens Bank at the time, didn't have any footprint here in New Mexico. I think that's changing. Chase is expanding here. I think Citizens Bank maybe did as well. But if your bank doesn't have a branch here, you probably want a new bank account here with a bank that does. Mhm. Last, I'm going to talk about some hidden opportunities that you might come across when you're moving, especially to New Mexico specifically. These are just things that sweeten the deal, maybe, but really they're just things you don't want to leave on the table. I mean, you don't want to leave money on the table, is the gist of it. The first is tax credits and other promotions, financial incentives. New Mexico, we have our tax code that's kind of written to incentivize job creation here in certain ways. I won't get to the broader arguments about our gross receipts tax. People who know me know my opinions on, some things that we could be doing better here, but there are some things that we do very well. And one of them is our high wage jobs tax credit. That is a very overlooked opportunity for employers offering certain high wage jobs to get a good chunk of the money that they're paying back through tax credits that are refundable in many cases. So, look at the high wage jobs tax credit, for example. There are a few other tax credits that are very industry specific in New Mexico. Research and development, we've got plenty of them. We've got plenty of tax credits that deal with investment and startup costs. Additionally, we have financial incentives that are offered through the state, through certain cities and municipalities, through economic development bureaus and divisions and organizations that are meant to incentivize capital investment in New Mexico. So it's worth consulting with a local accountant, CPA, tax attorney, someone who knows the tax credits, talk about your business, what you're looking to do here, and they can match you with some great tax credits and other incentives. It's also worth reaching out, depending on what you're looking to do and the size and scope and scale of your business and maybe your planned capital investment. Reach out to the economic development divisions of the city, the state. We've got some private cooperative economic development organizations here. Reach out and see if maybe there's financial incentives that are available to you to, put in some of that capital investment. Sometimes there's matching dollars, sometimes there's specific tax breaks that you have to negotiate on a one-off basis, but there's plenty of opportunity in New Mexico to defray the costs of your investment. And a lot of that ends up overlooked and unclaimed. So it's worth considering. Opportunity zones are an interesting thing that are often overlooked as well. They're a product of federal tax law, most recently updated in the Tax Cuts and Jobs Act. And it defers to state governors to designate certain tracts as opportunity zones to encourage and incentivize private investment in certain underserved areas. We have 63 of them. And if you invest in them, you might be eligible for certain tax benefits and financial incentives, LEDA funding, et cetera. There's a lot that goes into opportunity zones, but they can be quite lucrative in terms of investment. Part of the requirement, and this is why I'm mentioning them here, the funding of the capital investment project has to be of a certain size and be part of an expansion or an out-of-state relocation into New Mexico, into the economic opportunity zone. So, look into that depending on the size and scope of your capital investment, see if maybe that's something that you can leverage to get even more financial incentives. I mean, it's really, the gist of this entire section is there's plenty of opportunity that most people don't consider. But, besides that, a number of opportunities and resources that go overlooked can really help you get a good footing here in the state of New Mexico. The Small Business Development Center is one of the best that you can reach out to and utilize. They offer no cost business counseling, loan application assistance, training and workshops like this one. I mean, they are a great resource, especially as you're just getting started. And then on an ongoing basis, as maybe you're looking to expand or change your focus or something, there's a lot out there. There's also other nonprofit or government sponsored, grant funded mentorship programs and organizations, low or no cost. Um, Go to SBDC, sign up for a counseling session and see what they can point you to is probably my best recommendation here, because, you know, if you don't know your resources, you can't avail yourself of them. And if you don't avail yourself of them, you're leaving money on the table. So these are just things to consider, but remember, utilize your resources. Every business owner's situation is unique to them. It's important to work with qualified professionals who can help you um, relocate, figure out what your relocation is going to look like, map it out, figure out what some of these potential consequences might be, and really plan ahead for the best possible outcome. That is the best advice I can offer you right now. Um, so we're going to do a Q&A session. We've got a few minutes left on the clock. If anyone has any additional questions, I'm happy to answer them. Even if they're only tangentially related to what we just talked about, throw the questions out there and we'll
Well,
see.
and I'd like to see down the road, maybe having a webinar on opportunity zones and some of the, getting into some of the um, down in the weeds topics, because you gave a great overview. And I think the most important piece is that every business is unique to yourself. And so um, your situation is slightly different than someone else's, when you say, Ian.
Yes, I mean, absolutely. Everyone's situation is very unique and very different. And so, these resources, I only gave a few off the cuff examples of some of these resources that are available. I could do another session just on opportunity zones, or another session on tax credits, because the tax credits, our tax code is very dense. And there's a lot that's buried in there, a lot that is new, a lot that expires. So there's it's always changing, but I'd be happy to do more, explain more about some of those. We've got another question. When does a business who moves to New Mexico need to get a local business license? That is a great question. And business licenses are really interesting because they're typically handled on a locality level, municipal level. So, for example, the city of Albuquerque has a business license process for businesses that are operating within the city. You typically need a business license when you start conducting business. So once you register your LLC or corporation, if you're doing business within a specific territory, go get your business license for it. Oftentimes, counties have their own business license process that they require you undergo if you're operating in unincorporated territory. For example, Bernalillo County, I believe, has a licensing process that doesn't apply for businesses within Albuquerque because they defer to Albuquerque's own licensure process. So, there's licensure. It really does depend on where you're doing business primarily. It's important to research and figure out what the requirements are, because some localities don't even require business licenses. And you find, especially on a state to state basis, this really varies by state. There are some states where business licenses just don't exist, and some states where licensure is handled on a state level. So it's important to figure that out in advance as well.
Would you say that you would possibly contact the municipality of where you're going to be located first, and kind of just get that information into your kind of your plan and moving here to New Mexico?
Absolutely. I'd say that's part of doing your research. You can even just look up on their website by and large. Most municipalities, localities will have the business license process laid out there on their website. It'll explain when you need to get the license, which again is typically before you start doing business. And more importantly, how you get the business license. You know, a lot of these business license application processes are, 30 minutes on the website, it may be less. But sometimes if you have a brick and mortar store, it gets a little more complicated. Maybe you need an inspection from the fire department, you need some sort of certification that it meets code. Um, so it really varies, but I would absolutely say you should do your research as part of the planning process before you move.
Oh, I think there may be one more question. Do you want to answer it before we pop off?
If I've got the time, I'm happy to.
You do, yeah.
Um, so online businesses, when would they want to consider moving? Just when the owners move? And the answer is yes. I'm going to give you the 30,000 foot overview of why. When you have an online business, no physical footprint, no warehouses, no employees, boots on the ground, physical headquarters, etc. Most states, most states have the requirement that if you're doing business within state lines, you register your business there. And when you're dealing with online businesses that have no physical footprint, the state that has the closest tie to the business is the state in which the owners reside and are carrying out the business activity. So as soon as you move from state A to state B, all of a sudden, state B has the claim to have that business registered there, because all of a sudden nothing's occurring in state A and everything's occurring in state B where the owners live. So I would say yes when the owners move.
All right, I think that wraps everything up for today. And we want to thank you as always, Ian, for giving us this valuable information. And we will be seeing you again soon. Remember, check out nmsbdc.org for any no-cost confidential business counseling that we can give you. So you guys have a great rest of your day. Thanks.